Thank you.
Fine.
Yes, can you hear me okay?
Yeah, they can hear you. So let's go ahead and introduce Todd.
So welcome everyone to Penn Community. This evening we have Todd Adams, who is Senior Vice President of Sales at Lendistry. Todd is a seasoned Texas banker with over 20 years of experience in small business finance. He also has worked with the Lyft Fund, Chase Bank, and other banking institutions. Hold on one second, I'm sorry. We're going to welcome Todd Adams for the presentation tonight. Go ahead, Todd.
All right, thank you so much, Sonia. Thank you guys for inviting me this evening. We're going to talk a little bit about, I guess, access to capital and what my company offers, and that's Lendistry. Lendistry is a CDFI. We are a community development financial institution. I'm going to try and share my screen, and that way I can show you guys the presentation on Lendistry. But again,
So
Lendistry,
Todd,
yes, sir.
say, Todd, don't hold back now. So we already heard you were gonna bring it now. So don't hold back for the Penn community. Bring the
I'm
truth.
gonna try my best. Man. I don't want anybody
Bring
coming
it, Todd.
I don't want you coming after me, but I'm gonna try my best. We're gonna let you know what financial institutions look for and how to prepare ourselves and get ourselves prepared for it. So let me see if I can share my screen here in a second, and we're gonna just talk about Lendistry first, and we may cover a few things in regards to credit, the 5 C's of credit. Some of you guys may know about that as well. But hold on one second. Okay. Share. Okay, can you guys see that?
Yes, sir.
Okay. Can you guys see that?
Yep.
Lendistry, okay. Again, Lendistry is a CDFI. We are the largest led CDFI in the country. We're kind of a mission-based driven organization. Again, minority-led institution, provides economic opportunities and progressive growth to small businesses across the country. We are able to lend in all 50 states. We have hubs in New York, Maryland, Texas, which I have the Texas region, and California. And we're based out of California as well. Our business model, along with our non-traditional business model that is technology-led. We are a Fintech company. We kind of pride ourselves on being able to take technology and take it to the next level when working with our clients. The social impact that we've had on that Lendistry has had. Lendistry has deployed, and this here is going to say $8.7 billion. We have deployed over $9 billion to over 600,000 businesses across the country. And we mainly try our best to focus on minority-owned, women-owned, minority-owned businesses. Again, the technology, we have an ongoing investment in our proprietary technology to enhance the borrowing experience for all of our clients. Lendistry is uniquely positioned to use this technology to quickly and effectively deploy capital in a scalable way. So that's, we pride ourselves on that. And these are some of the entities that Lendistry has amassed since its inception. We are a community development financial institution. We are a CDE, we are a community development entity. And we also are a part of the Federal Home Loan Bank. And we are SBA, where we can do SBA lending as well, along with SBLC. We are an SBLC here in the United States, so it's only 14 designations for an SBLC, and we're one of the 14. Lendistry hasn't been around that long. We've been around since 2015. Is when our founder, Everett Sands, started this organization. During COVID, that's when we actually exploded, because that's when you had the PPP loans, the EIDL loans, and they needed institutions that could deploy those types of grants and funds and loans throughout the United States, especially to minority-led businesses. And that's when we started growing exponentially in 2020, 2021. And then again, we opened our office in 2021 in New York. We opened our office just last year here in Dallas. We were partnering with Texas Capital Bank. Texas Capital Bank wanted to have a CDFI that they can partner with, and they chose to partner with Lendistry. So Texas Capital Bank brought us to Texas with a $5 million gift to Lendistry to come here. And our goal is to really work with those clients that don't fit into their wheelhouse. So again, we've been here since 2022, August of last year. And this is Everett Sands. Everett Sands is has over 20 years of experience in the banking business. He was last at Wells Fargo before starting Lendistry, and he is our CEO. He's the founder and CEO of Lendistry. And again, we have deployed over $9 billion, over 600,000 clients. 75% of those clients are minority-owned and small businesses that we support. And as of this writing, we had over 4,000 businesses that take advantage of our technical assistance. And our technical assistance is is provided by another nonprofit arm of Lendistry, and that's called the Center. The Center really is our nonprofit leg that helps clients with their help them understand their financials. It helps them determine how they should structure their business. It talks to them about the importance of financials to a financial institution, and the importance of being on top of your game when it comes to your business, and also marketing, online marketing. We give them a lot of marketing tips, and we just really coach that client from start to finish until they're ready to go in front of a financial institution, a major bank, or someone like Lendistry, a CDFI. Loans, we do all kinds of loans. We have a long list of loans that we do. When we came here to Texas, we were really focused on four different loans. We were focused on just your regular business loan, your regular business lending. And these are the loans that we have. We can do anywhere from $50,000 up to $5 million, terms of up to 5 years. We have what we call also a non-revolving line of credit. We can go anywhere from $50,000 to $3 million on that non-revolving line of credit, and it's up to 2 years. All these particular loans are variable in their rate structure because of the environment that we're in right now. So we don't want to get caught up there like Silicon Valley with their investments. They actually really thought that those were safe, solid investments. And if our economy had kind of stayed the same, they would have been. But again, with the interest rates rising, it caused their profits to become lower. So again, the rates are variable on these particular types of loans. And when I talk about our non-revolving line, that is, say for instance, you get $1 million line of credit, and you go out and you use 300,000 of that $1 million line. Even if you pay that 300,000 back, immediately or within a year, you still only have 700,000 to use. It doesn't go back in and revolves back over. You have up to 2 years to use that full million as well. And if you don't use it, you start to pay back what you actually used. And if you need another line, another non-revolving line, we can do that. But in most cases, these are individuals that need a short-term fix or a short-term infusion into their institution, into their business, so they can develop or produce their project or products knowing that they're going to be paid back those funds, they're going to be paid those funds, pay back those funds within a short period of time. So that's what our non-revolving line of credit is basically used for.
Hey, Todd, can you expound on it a little bit more for the audience, as far as the revolving line? Because, what are the requirements? And you may probably gonna get into all that, but what are the requirements to get into that revolving line if, a lot of these small businesses are trying to get there?
With Lendistry right now on this particular product, it is a product that's for businesses that have been in business at least 2 years or more. Again, this non-revolving line of credit is up to 2 years. After 2 years, it turns into a term loan and it terms itself out. So you only want this particular type of non-revolving line if you know that there's going to be a big payout to you where you can in turn pay off the non-revolving line. It's basically a short-term fix for a lot of clients, for a lot of customers. So, and the rate is variable. Right now with Lendistry, our rates can be anywhere from, they can be prime plus, and we are prime plus 2 or 3%. So, and we can't go as high as 4. I think I've seen some at 5. So you're looking at what prime is right now. You just add a couple of more basis points to that. And we're not a predatory lender. We're nowhere near that aspect. Banks refer all their clients to me. I just left a meeting with Chase. Chase Bank is wanting me to work with their clients because they have a lot of clients that they just don't lend to certain industries. And we will lend to those industries. And the same thing with Texas Capital Bank when they brought us here to Dallas. They just have a lot of business that they can't service, and they needed someone like a Lendistry to help in that aspect. So again, that non-revolving line can go up to $3 million. It's something that's pretty much short term.
So Todd, I'm just trying to ask questions. I know,
Okay.
a lot of people ask questions and stuff. So what would stop someone from, proceeding to get a revolving line of credit? Is it the credit score of the individual person, or is it business credit outside of
our credit score? We like to see a person at least have a 640 credit score or better. And we have debt coverage ratios that are in place, like your debt coverage ratio, your business coverage ratio and your global coverage ratio. On the global coverage ratio, if you're at a 1, then you're good. On the business coverage ratio, we would like for you to be a 1.15. So what that means is for every dollar you spend, you're bringing in at least $1.15. You're getting that back plus 50. Well, you're getting 15 cents back. That's your profit margin. Is basically 15%. So the debt coverage ratio on the business is 1.15, and the global coverage ratio is 1, and that's just dollar for dollar. You spend $1, you pay out $1, and that includes, say for instance, you have a side business and that's bringing in sufficient income, and you also are still working for an employer where you're getting income as well. So we combine those two incomes, and that's your global coverage ratio. And those are the things we look at as well. And we have done loans. We have done loans below 640. We have done loans as low as 600. And we look at a lot of different variables when we start having exceptions. And that's what we're going to call that. We're going to call that an exception. So they didn't hit the credit score of a 640, so that's an exception. What can offset that exception? Well, one is your debt coverage ratio. You have a good debt coverage ratio, that can offset the exception. Or you have a high net worth. Your high net worth can offset that ratio, that credit score. So those are things that we look at and have mitigating circumstances. We're not trying to say no. We're basically trying to say yes in every instance possible. So we're going to try to find a way to make this deal work, as opposed to you coming in, okay, my credit score didn't quite hit the mark, but I have all these other positive attributes that can help as well. So any other questions or concerns? Is someone talking? I can't.
Good, Todd. Do you
Okay.
see hands, Rhonda?
I see a question that says, what options are available for newer businesses?
Newer businesses. Let me see. I will get there. I will get there in a second.
All right.
We have commercial real estate financing as well. That's another big one. The really great thing about a commercial real estate is that we can also do 50,000 to 5 million. And we have a 10-year term with a 25-year amortization. So that really allows that business owner to have much smaller payments over a longer period of time. So the 25-year amortization gives you the smaller payments. Instead of having a 5-year term, now you have a 10-year term. And after 10 years, you pretty much, if you hadn't paid it off by then you pretty much will do a refi. And we do those as well. We do the SBA 7A loan. Trying to see if I can get to your. Now this right here, this particular program is going to be a game changer. This program is a game changer. The contractor financing, not contractor and micro SMB. That is in a totally other state. That's in another state on the microfinancing. We don't have that yet here in Texas, but we do have contractor financing. And that, again, from 10,000 up to 1 million, up to 2 years, you can borrow money against your contract. So if you go out and you get a contract with the state, the city, any municipality, the airport, any ISD, you get a contract with them, we will give you 30% of that contract up front. So you can go out and hire new people, buy supplies and equipment to actually get your job started. So that's our contractor financing program, and very, very few institutions have a program like this. And we feel as though this is the one that's going to be the game changer for Lendistry, is our contractor financing.
Hey Todd, so traditionally, and this, a lot of people are going to run into this. So like if someone wins a contract with the likes of the enterprises like a Walmart or an IBM or Microsoft, we have a tendency to not pay people on time. Okay. Yep. So what type of lending do you have for those types of contracts?
And that's what this contract is about. This contractor financing, and I failed to say that, unless you guys know about that, but that's what it's for. It's for those individuals who get that contract, and it's going to be 60, 90, 120 days before you get your first payment. So that's what these funds are for, is to kind of help you bridge that gap until you get that first payment. And we're going to set up a partnership where when those payments start coming in from those institutions, we take out our payment, the rest goes to the contractor, so he can pay his salaries and pay his expenses and things of that nature. We expect for the 30% that we loan to this individual to be paid off within that contract period. So within that contract period, we expect that amount to be paid off. It's only 30%. We're giving you 90 to 120 days before any payments are going to be taken out, because we know what that consists of. But there are some government agencies that have to pay within a 40-day period. So we know that in 40 days, you'll be getting your first payment.
Right. Okay. Thank you.
You bet. You bet. Good question.
And is it only government contracts that you will finance this way?
You know what? That's how we started this program. We started this program because we know they're going to pay. The city's going to pay, the state's going to pay, the federal government, they're going to pay. So it was easy. But then we started running, when these contracts started coming in, it really wasn't a government contract with the city of Dallas trying to rebuild the convention center. It was a contract with that prime contractor who has the contract with the city of Dallas, who's going to pay. So now we had to start vetting those primes. And that's where we started running into some, not issues, but little hiccups here and there, because now we got to know, okay, what prime contractor are we dealing with at this point? Because there are a lot of big primes out there, you know, Austin Industry, McCarthy and Vaughn, Beck, all these big, huge prime contractors who go out and get the big billion-dollar deal, but they got to hire all these other little subs to come in and do some of their work. And these subs get a contract for $1 million, $2 million, $5 million. Then who's going to be paying them? Well, Austin Industries is going to be paying them, not the city of Dallas. Austin Industries is going to be paying. So we got to make sure that Austin Industries or any prime is a viable, bona fide prime that has paid everybody as agreed and on time.
Mm-hmm. So
But,
Todd, you guys just hold a contract, like i.e. like the Toyota, the Microsoft, you guys will hold a contract, pay it out, and then pay the vendor, basically is how it's working still?
say it one more time.
You guys will hold the contract, i.e.
No. The contract is the vendors. I mean, is the contractors. All we're doing is lending 30% of that contract, and we're setting up an agreement between us, between Lendistry and that contractor, that we're gonna have a joint account. The funds are gonna come into that account. We're gonna take our payment out, and everything else goes to the contractor.
Gotcha.
But our expectations will be to have that contract paid off within the contract period. And normally we would hope it wouldn't be any more than a 2-year period.
Mm-hmm.
And some of the other issues that we started running into were, we may have a contractor who has multiple jobs going at one time. He may have a contract with Toyota. He may have a contract with the city of Dallas. He may have a contract with the city of Arlington, and he may have 4 or 5 contracts going at once. So that was something that we didn't anticipate, but that's something that we're seeing a lot of, and so we're starting to satisfy those needs as well.
Ron had a question.
Yes.
Yes, 2 questions. One, it sounds like you're factoring. Is that correct?
I've heard that term before. Oh, is that factoring? It's not factoring, because factoring is going to take the majority of your money. Factoring is going to rob you. We're just loaning you whatever you need, and you're paying us back what we lent you plus whatever interest rate we're charging you. So that interest rate is going to be anywhere from 8 to 9, 10%.
Do you work with nonprofits?
Yes, that's what I was going to get to. Those 2 things: nonprofits and businesses that are less than 2 years, what we call startups. We do startups, and we work with startups, and we make loans to startups. As long as the individual that's starting that business has been in that industry for at least 2 years. So we don't want you to go out and
Pretty standard.
open up a restaurant and you've never done restaurant business. We don't want to see that. You may have worked in the restaurant for 20 years, and now you're like, you know what, I want to open up my own restaurant. You're a very good candidate for that. And then nonprofits are the same. We do nonprofits as well.
You do capacity building type of loans?
What is that? Say it again.
Capacity building?
Capacity building. But meaning your growth?
That means we've got services that we provide. We have community organizations and businesses that pay for our students' training, okay? But that model is not sustainable, because we want to give all of our participants that are underserved, marginalized, disadvantaged, and disenfranchised, we want our services to be free to them. So, but what we need is operational costs to pay our rent, our instructors, our insurance, those kind of things like capacity building. And
So
we need to be able
where,
to hire more people, those kind of things.
where would your revenue be coming from?
That's where our community service centers,
Okay.
and that's where our revenue is currently coming from, community service centers, community organizations, and donors that want to pay for the students, the student fees for participating in our program.
That one is going to be hard because community organizations, they go by the wayside all the time.
Okay, so now
Donors, they may do a one-time donation, or they may commit for 1 year or 2 years, and then they're gone. So your income is not steady, where you know you're going to get this income on a regular basis. So those are kind of, those are our challenge. I'm not saying we don't do them, because we're working on one right now, but his income is coming from a municipality, and he's
okay,
taking
so yes,
veterans.
yeah, let me give you a scenario.
Okay.
We would have someone to say, listen, once your graduates graduate, we'll pay for the tuition once they graduate and get their license. So in other words, they'll pay our $2,250 per person, but they won't pay it until after our students graduate the program. You understand what I'm saying? So that way they're not dropping out. They didn't pay the money and the student drops out.
Right.
They don't get their certification, they don't get the license or any of those things. And then they've paid money for nothing. But if we graduate the student for the 10 weeks or the 8 weeks through the program, they will give us the money. So I don't know if they're invoicing us or they're gonna, we invoice them for that, or they have a promissory note or a promise per documentation. But I didn't know if something like that would work.
That's gonna be tough, because when we make a loan, like when you go buy a car, when is your first payment due?
I got you. I understand. I'm
30
just
days.
asking because I don't know.
Yeah, we don't. I'm not gonna say we don't, but we have something similar, and I'm working on something similar to that. But that guy is getting, his revenue is coming in through a contract with a municipality.
No, got it. And I'm going to be getting something similar. So understood.
Right.
Last question.
Yeah.
Since we're a nonprofit, there is not an owner.
Right.
Okay. The public owns the organization, right?
Right.
Now we are minority operated. Okay. Now the one thing I did was we would get some type of loan. Is it the individual, the founder, that has to have a credit rating, or what? Is there a certain credit rating that the organization has to have?
We're going to look at the organization, and we're going to look at how long that organization has been in existence. And
4 years.
yeah, and so when we look at those things, we're going to look at do they have a credit rating? Do they have a Dun & Bradstreet? You know, we're going to look at those things on that nonprofit, because you're right, nonprofit is not, we can't hold an individual accountable for that organization. So
And I understand that nonprofits we don't have a Dun & Bradstreet number either.
right. I mean, well, have I ever seen a nonprofit?
Yeah, they have them.
Yes,
That's
I
why
think.
I'm gonna ask you the importance, so everyone on this call can understand the importance of having a Dun & Bradstreet number.
Yeah.
I know on the other side, the for-profit side of the world, you can't even get a stick of bubble gum at Walmart if you don't have a Dun & Bradstreet number. You can't even do business with Walmart.
Yeah, absolutely. So you gotta have.
I don't know that. No, from my research, I have not found, because the Dun & Bradstreet wants to know information about the owners.
Yeah.
And we're publicly owned. So I'm not sure. So unless you know something I don't, and I'm here to learn.
Now, a lot of
How does
times they want to know
nonprofits get a Dun
something.
& Bradstreet number? Let me know.
Yeah, a lot of times they want to know something about the officers of that organization.
Right.
Who are the officers? Are these reputable officers? They're gonna want to find out a little bit of information who those officers are on that nonprofit, because you know as well as anybody, everybody goes out and does a nonprofit. Everybody wants to do a nonprofit. So we want to make sure that, okay, we're working with this nonprofit. They've been in existence for 4 years, and they come into us for $500,000.
So Todd, and I know Ron had questions, so we've got, because of time, I want to make sure that we get everything in.
Okay.
And keep moving and give other people an opportunity to ask a question if, you know, if somebody wants to ask a question.
Yeah. Okay. And actually, I'm gonna give you my information. We can talk offline as well, and then I can probably get even more information for you. But again, this, like I said, those were some of the products and services that we offer. The business lending, the non-revolving line. We do the nonprofits. We do the startups. We do commercial real estate, SBA 7A program as well, contractor financing. We don't have any micro lending going on right now, or any government-backed grants going on. Out of that $9 billion that we have deployed, some of that has been through grants and loans. And those grants are backed by a particular municipality. New York has a grant. Chicago has a grant. Arizona, Phoenix has a grant. California has a grant. So these individuals have backed these grants to give to certain businesses in the community up to maybe 25,000. We're not doing those smaller loans yet, and we don't have any backing by the state or any municipality in the state of Texas. So nobody's doing that right now. I think there may be one that just came out that's in San Antonio. They can give, this is something really, really small, in $1,000, $2,000, $5,000 loans, grants that they can give out to small businesses. We're looking at 50,000, and I'm gonna tell you, I'm gonna be frank up front, our sweet spot is gonna be at least 500,000. We're looking at businesses that need those types of funds. But at the same time, we have those 50,000, 100,000, 150,000, $200,000 loans that we do daily for individuals that are growing. They're scaling their business. These are minority-owned businesses that have been successful, that are doing some great things. Now they're able to scale their business to the next level. And now they need something other than 25,000. They need something a little bit more. So with that, any questions about the products and services?
Hey, Todd, so let's go back to the startup businesses for some of the who might be a startup on the call. So what is the cap on the startup business? Is there a minimum and a cap?
Startups up to $1 million.
Okay.
50,000 to $1 million on startups.
Gotcha.
So,
and that means they should come, fully equipped with the business plan and everything else, right?
Yeah, absolutely. Gotcha. And what I'm getting ready to talk about now, and I had a computer over here that it appears to have crashed on me, but I have the information that I was going to talk about, and that's on the credit side.
Yeah.
Now we're going to get into the credit. We're going to get into, are you bankable? That you go to Chase, you go to Wells Fargo, you go to B of A, they want to know, are you bankable? And a lot of times they get individuals that aren't bankable right now. So if you're not bankable right now, what's going to make you bankable? They're going to say, well, you know what, right now we can't help you, but we have a partner that may be able to help you, and they're going to send you over to Lendistry. And that's where we step in to see if we can help you in your financial or your capital needs. What I'm going to talk about also is the 5 C's of credit. And you may have heard, some of you guys may have heard of the 5 C's of credit. I was in a presentation with Chase the other day, and I had a young lady in there. She said, I've heard all this stuff. I've seen this before. I've heard this. You guys are going over things I've already heard. And I've been doing this for 30 years. So it's nothing that I wouldn't want to hear again, because it reinforces the fact that this is important. These things are important. So I'm gonna talk about the 5 C's. And then I'm gonna talk about credit scores and what those credit scores look at, and what are some of the dynamics of your that gives you your particular credit score. But out of the 5 C's, my first C is gonna be credit history. That's the history. The history of your credit is a good indication. It's a good prediction of success, of you successfully meeting your obligations. So when we look at your credit history, how have you paid in the past? Have you had some bumps and bruises along the way? Have you had issues where you've had things charged off? Have you had bankruptcies, whatever the case might be? Or have you paid as agreed over the life of your credit record? So credit history is a prediction of how successfully you will meet your future obligations. Collateral. We do request collateral on our loans. All of our loans have to have some form of collateral. In the state of Texas right now, on startups, we would prefer you have some real estate involved. Now, 48 other states don't have to have that, but Texas and Florida has to have, I'm sorry, these 48 other states, they can do real estate and they can use their primary residence. Texas and Florida cannot use primary residence as collateral. So we like to see if you have any investment property, anything, any other types of real estate that is either free and clear or very, very low balances in order for startups to get a certain amount of money. So collateral is another big issue, is another big key to getting a loan through Lendistry and any other financial institution.
Hey, Todd, excuse me. Hey, this is Anthony. Do you guys have any secondary to that real estate, or is that the only thing that you guys are looking at for a requirement?
Meaning, will we be second on real estate, or do we have other collateral that we would take?
So yeah, for a startup, for the collateral, if they do not have that real estate piece.
We'll look at if your business is 2 years or more, then we'll look at a UCC. We'll look at just a blanket lien on all of your business assets. So we do those on businesses that are 2 years or older. Businesses that are less than 2 years, they have to have real estate right now. And I'm fighting extremely hard to change that for Texas, because I've been lending money for 30 years and we've always been able to use equipment, big, heavy equipment, vehicles, trucks, supplies. We've been able to use all of those things as collateral in the past with the other financial institutions that I've worked for. It's just that they've been so accustomed to being able to use a person's primary residence in these other states that they don't understand the dynamics of Texas. And we have good, viable businesses that they want to go out and buy a $300,000 machine that takes up asphalt. And why can't we use that as collateral? Any other time I would have been able to use that as collateral. But right now, until my argument gets to the right ears, it's going to be real estate for a startup.
Quick question. So my business is primarily services. I've been in business for more than 2 years, but can you use future business as collateral versus real estate?
We're going to look at how much you're asking for. And we're going to look at, is it all going to be operating revenue? Operating needs? Are you going to be using those funds to purchase equipment? Are you going to use those funds for payroll? What are you going to be using those funds for?
Influence for the business payroll.
So we can we do loans, operating loans as well, operating capital. We do loans, and since you've been in business more than 2 years, then we're just going to look at your business assets and just do a blanket lien on all your business assets.
Okay, thank you.
Absolutely.
I got a quick question. Antoine with Barnes Concept Drone Services.
Mhm.
Do you have veteran veteran products?
We have a program that, well, I'm not gonna say it's specifically for veterans. It is, we target veterans, but it's not anything special, so to speak. It's not, okay, oh, you're a veteran, so we're gonna give you this discount, or we're not gonna do this particular thing on this loan because you're a veteran. We haven't gotten to that stage yet. But we target veterans. We work with veterans. I have the guy who works for the Veterans Administration who sends clients to me all the time. But we work with veterans, and we don't have anything that's discounted or special just for veterans.
Okay.
My next is going to be capacity. Capacity. Your ability to repay the loan, your cash flow ability with the loan. And do you have any outside income? So that capacity is probably the most important piece to us because that tells us about your cash flow. Now, like I said earlier, you may be making a certain amount of revenue or income through your business, and you may have a full-time job as well. So that's really important when you're relying on your income from your full-time job to kind of service some of the debt as well on your business. So we want to see what's that cash flow look like. Do you have secondary cash flow? And in a lot of businesses that are startups, they do have both of those types of incomes coming in. But there are some businesses that I'm at that point now where it's all in. I'm all in, and this is my only income is coming from my business. So we want to know, what's your capacity to repay? Then we have conditions, current conditions of the market, current conditions of your industry. If it is not the bank's policy to loan to the particular industry, they will not, regardless of the C's, meaning a bank is not going to loan to anybody if those conditions of that industry are not positive. Trying to think of something that is happening. Oh, what's the currency, cryptocurrency type thing. You're not going to get a financial institution to lend money to someone in the cryptocurrency business. Not now. There were some banks who tried to get into that business and it failed. But again, it depends on the conditions of the business, the current conditions of that industry as well. And that's a very important C as well, the conditions.
Hey,
and then
Todd.
Yes.
Hey, this is Dean again.
Yes, sir.
What, for like small businesses and startup businesses, what due diligence platform or deal room software are you recommending that they should use?
Wow, Dean, that's a good question, buddy. Because I can't recommend anything like that.
Can I make a recommendation?
Yeah, absolutely.
You need, so what I used to do is I would go get MBA students at the local college and have them do the pro forma.
Mm-hmm.
Most minority businesses fail because, so our bankers here talking about, they do a joint agreement. So the problem is no one gets paid in 12 months, but everyone does a pro forma as if they're going to get paid in 12 months.
Mm-hmm.
With his joint agreement, the money is in a lockbox. You got to have his permission on what he takes and then what he leaves you. So most minority businesses that I've seen that have failed are because they didn't understand that the pro forma is never 12 months. They didn't understand that also the customer or the or the person who's paying you changes your cutoff date. The cutoff date is their internal system for your invoices have to be in and processed before. So as an example, I was a longtime supplier for Delphi, and my cutoff date was the 26th. And then as they got closer to bankruptcy, they moved it to the 21st. Well, basically my pro forma, I was getting paid out on 15 months. So the question I have to ask the banker is, once the payee at the top changes the cutoff date, what language is in the contract on that lockbox to give the minority supplier or the business some relief?
Yeah. That's some very good information. A lot of people do use business students to do a lot of their finances, because we're going to look at the balance sheet, the income statement, and cash flow statement. Those are three financials that we're going to look at all the time. And if you can get a business student to do that for you, you're 10 steps ahead of the game. I've been doing this for a number of years, and I get clients come in all the time, hadn't completed their tax returns, don't have any financials together. So those are very, very important aspects of the success of your business. And again, we start these businesses, and we want these businesses to take the income that we left on our jobs to replace that income. And it doesn't always do that immediately. There are lots of expenses and things that you have unforeseen expenses that take place, that you're going to have to use those funds for your business as opposed to your well-being as an individual, the income that you left over at this job to take place for your business to take place of that income. And again, 1 year, it's going to be hard to do. So a 2-year pro forma, yeah, that works out even better, because you're able to say, I need to live very, very meagerly, so to speak, in order for my business to be successful. And what was
Can I mention another? So also a big mistake that minority entrepreneurs make is that they work 60 hours a week and they pay themselves 40. And what you should do is set up a loan from you to the company for the 20 hours you didn't get paid for. Now, when the bank comes in, they're going to make you subordinate that loan to them. But if you do start to make a lot of money, the money will come back to you tax-free. So the most important part about being incorporated is be able to take advantage of the tax-free income. So you should always set up on the extra hours you're not getting paid for, and then accumulate those every week and every month in your financial statement. And once you become successful, you can get that money back because it came in as a loan.
Yeah, absolutely. And that's your equity injection a lot of times that you can put into, that's your loan to the business. So you're very, very astute when it comes to what you're saying, what you're talking about at this point. Those are some very smart scenarios, and some very, very good information that everyone could probably use. So yeah, thank you for sharing that, for sure. That's very good.
Todd, as you see, we'll have to have, Uncle Bush Carter back on here to really expound on that, because a lot of people are probably not going to get that in one setting,
And that gets a little deep.
Yeah.
And a true business person may understand it, but even then, you got to get some accountants involved.
Yeah.
Yeah, that's some good information. I really appreciate that. And then really, guys, my last one is on the C's is cash. We always like to see your equity injection. How much are you going to put into this business? We want you to bring some skin to the game, so to speak, and that can be anywhere from 15 to 30%. So those are the 5 C's, including cash. And again, those are things that banks look at. They look at those things. Credit scores. Like I said, we do a 640 is our minimum. We can go below 600. I mean, to a 600 credit score. But I'm going to tell you some tips on credit scores and how they are determined. As you know, credit scores go all the way up to 850, anywhere from 300 to 850. 35% of your score is based on your payment history. So 35% of your score is based on that payment history. Then 30% of your score is based on your outstanding debt. How many of you guys see all the time if you use Credit Karma, they don't want you using any more than 30% of your available credit. So they want to keep you below 30% or below. That's a good indication that you can manage your debt effectively. So 30% of your credit score is based off your outstanding debt. And then 15% of your credit score is based on the length of time you've had credit. So those of us that have been around for a minute, 30 years in this game, I've got some old credit lines out there. So it helps with my credit score, but it's only 15%. And then 10% of your credit score is based on new credit. So when you go out there and get some new credit, that only helps you 10% of the time. But to a lot of individuals I tell them, you can increase your credit score by getting more additional credit cards. Why? Because it gives you additional open to buy. And when you have more open to buy and you're only using 30% of it, that helps increase your credit score. So when you get those pre-approvals, don't always turn them down because you think it's going to hurt your credit score, because it's going to hit you for about 30 to 60 days. If you don't plan on doing anything in 30 to 60 days, your credit score is going to shoot up because you have less, your debt coverage ratio is going to be less because you have less credit, but you have a larger amount of credit opening, but you have less that you owe on that. And then the other 10% is going to be based on the type of credit that you currently have. So another 10% is going to be based on the type. And if all you have are credit cards, it's not going to help you that much. But when you start adding a high revolving debt in regards to car loan, a mortgage, then that helps your credit score as well when you start adding those types of debt into your mix. So we don't want to always have just all credit cards. We may want to have a mortgage there that helps out, a car note helps out, a personal loan helps out as well. So any questions and comments in regards to that?
Rhonda, can you see if any show of hands, Rhonda, can you acknowledge them?
I don't see anyone else with the hands up right now.
So Todd, it seems like you did such an outstanding job that nobody had questions. I think now is the time for everybody to line up and come and see you, Todd.
Absolutely. There's my information right there on the screen. My phone number, that's my email address. Let me see, where is my other? Yeah, if you look at this link here, the cloud.mail.lendistry.com/BDO, question mark code equals Todd Adams, all of that takes you straight to this right here. It takes you to I'm ready to apply. And when you get to my link, you can scroll down and you can see a lot of different things that Lendistry has to offer. Tips for applying. When you apply, you got to know how to use Plaid. Some of you guys may know what Plaid is. That allows us to see 3 months of your bank statements. How to use Persona. Persona is where you scan your face. You scan your face and you have your ID as well. That's where our Fintech comes in. And then completing SBA Form 413 and completing SBA Form 1919. Even though this may not be an SBA loan, it may just be a regular traditional business loan. We use those forms because it gives us all the information that we need. And basically the 413 is a personal financial statement. So it tells you what those tips on applying, and it just talks about Lendistry and how we are a CDFI, and we are part of the Federal Home Loan Bank of San Francisco.
Todd, can you do me a favor and copy and paste that link into the chat so everyone can get a copy of it?
Yeah, I will, sure will. Oh, where's my chat? Okay. Any questions, guys? I've enjoyed the time spent with you all.
Yeah, Todd, we'll probably have you come back, quite a bit, because we're trying to do this thing and get everybody acclimated and educated on how to gain access to capital or contracts. As you know, it's only the struggle right now is definitely access to capital for a lot of minority-owned businesses. Yeah. So it's just having a more understanding of how, he or she gets to the next level and have the right tools to come and seek Lendistry or any financial institution. Right. But I have to put a lot more out there just so that everybody, can get wind of it and get up under the umbrella and start to, practice these type of things. Right. So that yeses, when we start to come to, Lendistry and others. So
good deal. But we really appreciate it. And I'd love to have the business sit and talk with anyone that has a capital need. And again, if 50,000 is not where you're at and you need something less, I know individuals at other institutions or other CDFIs that have programs set up for amounts less than 50,000, Lift Fund and People Fund and Dream Spring and all those guys. They do a lot of their mission is to make those smaller loans to those smaller businesses that are not at the level where they want to be just yet.
So again, Todd, we thank you so much, man, for taking the time out, being a part of the PN community tonight, and also continuing to be a part of the PN community and help, business get to the next level. I mean, we need a lot of champions like you, Todd. So we're gonna keep leaning on you.
I'm here, man, and that phone number is available anytime. I'm working until I fall asleep, and it's 10 o'clock at night. If you want to call me, call me.
All right. Well, I want to thank everybody for participating today, here in the PN community. And like I said, we want to continue to do this and continue to scale and grow, across the U.S. Let's everybody get educated and understand how to gain access to capital. Todd, again, thank you so much, man.
Thank you, guys. I appreciate it again. Thank you.
Thank you. Right. Good night.
Good night.
All right.